Hello, my name is Danny Singh. Thank you so much for coming to the financial seminar. I'm going to talk to you today about the concepts of credit. Some of you are already familiar with the concept of credit. Credit is your history to prepay loans, and without credit, you cannot get anything in this world. 60% of employers check credit, so even if you have a degree but you have bad credit, it can cause you to struggle to get a job. For this reason, it's more important than ever to check credit. When you have good credit, it adds credibility to your degree. Having good credit also benefits the economy as a whole. Any advice that I give is based on my own personal financial experiences. I do my mom's finances. I was able to refinance her house and car when I was 14. I took over her finances after my stepfather was irresponsible in paying the bills. Some of my advice may seem subjective, but I back it up with evidence to support my claims. And if you have any questions, you can ask me after the presentation or just email me. I offer free credit counseling services. So I'm very passionate about helping consumers avoid debt, and I'm always for protecting them. Why is good financial behavior important? If you have good credit, then you have good financial behavior. Having good credit makes it easier to save for money, such as insurance, because insurance providers check your credit score. When they see that you have a high credit score and little or no delinquency, they can offer you a cheaper insurance premium because they feel as though, because of the fact that you have good credit, you're less likely to stop paying the insurance. And so when you save money on insurance, you have more money to contribute towards your IRA account, individual retirement account, or you have more money to pay off your student loans or other debts. However, the goal is you should never build debt. For example, you should never build balances on credit cards, because when you build balances on credit cards and if you default, then they have the power to take you up to 30%, and it makes it harder to save money for anything else. And when you don't have good financial behavior and your credit gets ruined, then it becomes a struggle to find a job, and that's when you become prone to file bankruptcy. And bankruptcy alone can cost $1,000 or more. Having good credit also secures your family's financial future, because when you have good credit and you can save money on insurance, credit cards, and mortgage payments, then you're more likely to save more money for your children's college education. So good credit is always the goal of every consumer. Creditors such as Bank of America, HSBC, Chase, they are considered creditors. They grant you credit. They give you loan money, such as a credit card, an automobile, a mortgage, anything. Utility companies and whatnot, they can also be considered creditors, because if you don't pay the water bill, for example, they have the power to report that as negative information to your credit reports with the consumer reporting agencies. A creditor can be a financial institution or a company. Some companies that offer credit, such as an auto loan, they don't necessarily specialize in granting mortgages, such as, for example, Ford Motor Credit. They only grant auto loans. They don't grant mortgages, checking accounts, or other types of loans or financial products. The purpose of credit is to show that you can be trusted in paying back loans. You're not someone who will be given a credit card or a loan, and the next thing you know, the bank doesn't get any payment from you. It shows that you're trustworthy. It shows that you can spend responsibly and pay it off. Another purpose of credit is to protect yourselves from scams, because credit cards have much more protection than debit cards and checking accounts. Someone can clean out your bank account with a debit card, but with a credit card, they can't do that because the financial institution will block them immediately. If your checking account becomes clear, then you have to file a police report, and until they conduct the investigation, you're out of any money. With a credit card, that can't happen because they reimburse you immediately. You have 0% liability with almost all credit card providers. When you have credit, it means that you have some type of loan under your name, such as a student loan, credit card, or anything. So when people say, I have good credit, that means that you've never been late on a bill, you've been successful in paying all your bills, you have no delinquencies. When people say, I have bad credit, that means you've been past due on some kind of bill for 30 days or more, you've declared bankruptcy, or there's something negative on your credit report, such as a collection account. Your credit history suggests your level of credit worthiness. Credit worthiness is the level of trustworthiness you have in paying back a loan or service. Credit cards, you must need them. Even if you have a student loan, a mortgage, and you never have a credit card, that can hurt you. You must have a credit card, because insurance providers, employers, and so on like seeing that you're able to handle a variety of credit. A mortgage, for example, is a secured loan, whereas a credit card is an unsecured loan. An unsecured loan means the bank is trusting you blindly. They're giving you $5,000 without making you give them $5,000. However, a mortgage, let's say if you stop paying it, they can repossess your house. That's why it's considered a secured loan. The bank is securing themselves. But with a credit card, if you don't pay it, there's nothing they can do. So it's an unsecured loan. And when you have a credit card, it shows also that you're less likely to cheat companies or financial institutions in the future. Some bad credit guarantees paying high interest and fees. When you have bad credit, your mortgage payment, your insurance payment, they become much higher, because when you have bad credit, it suggests that you're very likely to stop paying one day. And so for this reason, they need to make the maximum amount of profit off of you while you're still paying the bills. And so they're going to charge you the highest monthly payments and the highest interest rates so they can make the maximum amount of profit. That's why there are some credit card companies and banks that offer credit cards with interest rates of 79% or more, because they cater, they market consumers with bad credit. They're trying to make the maximum amount of profit off of them. So don't put yourselves into a position where you need such a bad credit card. If you keep getting denied for credit, then do not get a subprime credit card. A subprime credit card means that the bank is specializing granting credit to consumers with bad or no credit history. Subprime credit cards are dangerous because they have high interest rates and high fees. I've seen some subprime credit cards that have interest rates of 29%, 59%, 79%. Don't get those no matter how desperate you are. Get what's called a secured credit card. So for example, if I have bad credit and no one will grant me credit, I can go to Wells Fargo, I can give them $300, they'll give me what's called a secured credit card. So they're trusting me with $300, that's how much I can spend. If, for example, I don't pay the Wells Fargo credit card, then they get to keep the $300, but they still ruin my credit history. A secured credit card, when you've established years of good payment history, then they'll upgrade you to an unsecured credit card. They'll give me back the $300, and now they can trust me blindly. A secured credit card, regardless of your situation, is the best way to build credit. However, be warned that most secured credit cards have what's called an annual fee. An annual fee is a fee that you pay every year just for having the card, even if you're not using it. So the goal is to get the cheapest annual fee credit card possible. And from my experience, usually credit unions offer the cheapest secured credit cards compared to banks. And make sure after they upgrade you to an unsecured card and hand you back your security deposit, ask them to waive the annual fee. There's no need to pay it now that they can trust you blindly. To establish good credit, you first need to check your credit reports on annualcreditreport.com, even if you've never had a loan or credit card in your life, because you need to make sure all the information the credit bureaus have on you are correct. This is because, let's say if you apply for a credit card and the credit bureaus have your date of birth wrong, and the bank is trying to verify this, and they can potentially deny you because they think that someone with a fraudulent intention is trying to get credit under your name. So you have to make sure all your information on annualcreditreport.com is right with all three agencies. If it's not right, you need to dispute it and call the credit agencies. Do not apply for credit until they've corrected the information. Make sure when you apply for credit you have a source of income, such as a savings account or a job, because most financial institutions ask for pay stubs. They want to verify you're capable of paying them. If you're denied for a credit card, don't just give up and keep applying. Credit checks lower your scores because it sends the message, even if you've never had a credit card or any kind of credit history, it still sends the message why you're so desperate to get credit. So don't get too many credit checks. They lower your score, and they sometimes make your insurance premiums increase. When you have a lot of credit checks, it suggests that you're very likely to stop paying the insurance or some type of bill. So don't keep applying for credit aggressively. Use a website called financeglobe.com to determine which credit cards are the easiest to get if you can't even get a secured credit card. From my experience, department store credit cards are sometimes the easiest cards to get, but they have very high interest rates because they're catering to people who have little or no credit history. So that's an option for you to choose. Make sure when you have a credit card, don't close it. Use it once every 6 months. Do not build a high balance. If you have multiple credit cards, only use one, but monitor all of them for fraud. And make sure you're paying it off at the end of the month so you avoid paying interest. When you carry a balance on a credit card, it lowers your credit score because it sends the message that you're spending way beyond your means. So please avoid doing that. If you lose your job and you have a balance on your credit card, in reality, you should never have built a high balance, such as $6,000 or more, to begin with. But if you lose your job and you have all this credit card debt, contact a nonprofit credit counseling agency, such as In Charge. Some credit counseling agencies on the internet and even on television are scams. Credit counseling agencies are usually a better alternative than bankruptcy because bankruptcy attorneys usually charge lots of money to declare a bankruptcy or debt settlement. A bankruptcy means that you're discharging all your debt and you're ruining your credit. Bankruptcy stays on your credit report for 7 to 10 years. It's viewed negatively by employers. Debt settlement means you take all your debt and you pay half of it. So avoid doing that. Credit counseling is almost always a better alternative. Credit counseling agencies do charge fees, but they're usually much cheaper than how much a bankruptcy attorney or debt settlement attorney would charge you. Make sure before you do business with a credit counseling agency, you check the reviews on the internet because not all credit counseling agencies are legit. A credit counseling agency, the way this works is you pay them money and they pay your creditors money. They also work with your creditors to reduce your interest rates, waive any late fees, and offer you the most incentives so you can pay off your debt in months instead of years. The credit counseling agencies are partially funded by the credit card companies. That's because they would rather get something from you rather than nothing. One more danger about credit counseling agencies, if you do that, they will close your credit cards and it will lower your credit score, but that is still better than being delinquent and never paying them at all. So always, if you lose your job, contact a credit counseling agency. They also have some options for people who are unemployed. And while you're looking for a job, do any job possible, even if it doesn't relate to your career, to get extra sources of income. That way you don't default on anything and don't lose your home or apartment due to a foreclosure or eviction, or you don't lose your car due to a repossession, because that can mean serious problems for you when you seek to find a better job in the future. Okay, credit scores are called FICO scores. FICO, Fair Isaac Corporation, is the company who started the credit scoring models. Some lenders use different scoring models, such as Vantage Score. There's a bunch of other fancy names on the internet for credit scoring models, but most lenders use the FICO scoring model. Only check your credit scores on myfico.com. The other websites that are offering free credit scores and whatnot, they are not considered authentic. They are all trying to replicate FICO score's model, and that will not give you the most accurate picture of your credit information. Usually if you have a credit score of 660 and above, then you have overall good credit. But if you have a credit score of 659 or below, then you're very unlikely to pay back the loans in the eyes of the lenders because you have bad credit. Sometimes credit scores can become low for minor reasons, so don't let it discourage you. For example, if you've only had a credit card for 6 months, then it's unlikely your credit score is going to be high. A bank cannot look at just 6 months of history and say, oh, this person's going to pay the bill. They need to see years of credit experience. And one more lesson, when you pay off a credit card, do not close it. Keep it open, because if you close a credit card, it looks like you cannot pay it if you kept it open. And when you close a credit card in 7 to 10 years, it drops off your credit report. It looks like you never had it, and all that payment history you established is gone. So it was a waste of time paying it. So do not close credit cards. However, if there is an annual fee that you can't afford to pay, then close it. But before even doing that, negotiate with the bank to see if they can remove the annual fee, because sometimes banks do that because they want to keep your business. Only check, again, your credit score on myfico.com. Other websites that are claiming free credit scores are sometimes scams, because after 7 to 10 days of a free trial period, they will bill you monthly, usually $30 or $40 a month. So be careful of those websites. Myfico.com is the only authentic website there is. The credit bureaus, Equifax, Experian, TransUnion, and some lenders now use Innovus. There are 4 credit bureaus. 3 of them are major. 1 of them is minor. The minor one is Innovus. The major ones are Equifax, Experian, TransUnion. Banks use one of them when you apply for credit to check your credit report. The credit bureaus collect financial information based on what the banks are reporting to them. So if I have a Capital One credit card and I pay it off in February, then Capital One will report to all 4 credit bureaus that Danny paid his credit card in February. If I don't pay it in, for example, March, then they will report that I did not pay my bill in March, and that will lower my credit score. The credit bureaus do not collect information such as your checking, savings, IRA, or 401k account. They only collect information regarding what loans you have. The Federal Trade Commission monitors them. The credit bureaus are not funded by the government. When you pay them to check your credit report or credit score, or when a business pays them to check your credit report or credit score, that is how they make money. It is your responsibility as a consumer to check your credit report with all 4 agencies, Equifax, Experian, TransUnion, and Novus, every 6 months. That's my personal recommendation. You do not want any bank to report a collection account or any kind of negative information to them. And if they do, you need to dispute that immediately and have it deleted. And it is free to dispute information. It is your right as a consumer. Let's say if you have a negative checking account, you need to make it positive immediately, and you cannot open up too many checking accounts at once because sometimes that also sends a red flag. The consumer reporting agency that's responsible for collecting negative checking accounts is called Check Systems. So let's say if I have $0 in my Wells Fargo checking account and I charge $60 and they pay it, Wells Fargo will report that negative checking account to what's called Check Systems. Check Systems is the company with whom banks check to make sure you don't have any negative checking account. When you have a negative checking account, it sends them a red flag that you're going to make any new savings account or checking account with them negative. Also, Check Systems, if you're applying for many checking or savings accounts at once, Check Systems will report the financial institutions as a red flag because it makes no sense why you need so many checking and savings accounts as once. So if you have a negative checking account, you're going to struggle to open up a new checking account. And sometimes when you have a negative checking account, the new financial institution with whom you're trying to open up a bank account, they will charge you a monthly fee because you're very high risk of making the checking account negative with them. Some people who have negative checking accounts can never open up a checking account again until they've made those checking accounts positive or savings accounts. And so they will go to what's called a cash store. A cash store is you hand them your check from your employer, they cash it for you, they charge you a fee, and you get the cash. But those are not safe because let's say if your house burns down, you have no protection, you're out of the money. Whereas if you put your money into a bank and the bank burns down, you're still reimbursed the money because